Welcome. Let's continue preparing you to pass the Securities Industry Essentials, or SIE, exam. This video aims to enhance a person's understanding of various option-related concepts. We'll cover topics like hedging or speculation, expiration date, strike price, premium, underlying security or cash settlement, and the differences between in the money versus out of the money. We'll also explore covered versus uncovered positions, American versus European exercise and assignment procedures, and varying strategies such as long and short. Plus, we'll touch on special disclosures including the Options Disclosure Document and the Options Clearing Corporation for listed options. Let's start by answering the question, what is an option? Well, an option is a derivative security, and in the simplest terms, it's a contract whose value is derived from the movement of an underlying stock, index, currency, or other asset. These derivatives trade in markets that closely resemble those where stocks and bonds are traded. The foundation for understanding options is to examine the essential terms related to any option discussion. Equity options terminology. Let's talk about buyers and sellers. An option is a contract entered into by two parties. On one side of the contract is the buyer, owner, or holder of the option, who is considered long the option. The buyer pays the option's premium, which is the contract's market price, and gains the right to exercise the contract. Depending on the type of contract purchased, the holder can either buy or sell the underlying security. On the other side of the contract is the writer or seller of the option, who is considered short the option. The seller receives the option's premium and takes on an obligation if the contract is exercised in the future. Depending on the type of contract sold, the writer may be required to either buy or sell the underlying security. Remember, a buyer pays the premium and receives the right to exercise. If the option expires worthless, the premium paid reflects the buyer's maximum loss. A seller receives the premium and assumes an obligation if exercised against. If the option expires worthless, the premium received represents the seller's maximum gain. Types of options. The two types of options that may be purchased and/or sold are calls and puts. A call option grants the owner the right to buy the underlying security. A call option grants the owner the right to buy the underlying security. In other words, a call buyer can call the security away from the writer at a fixed price. The writer of the call has the corresponding obligation to sell the security at the fixed price if the owner exercises the contract. Buyers of calls are bullish. They want the underlying asset to rise. Sellers of calls are bearish. They want the underlying asset to fall. A put option gives the owner the right to sell the underlying security. In other words, a put buyer can put the security to the writer at a fixed price. The writer of the put has the corresponding obligation to buy the security at the fixed price if the owner exercises the contract. Buyers of puts are bearish. They want the underlying asset to fall. Sellers of puts are bullish. They want the underlying asset to rise. All right. Let's dive into the components of an option. An equity option is essentially a contract that gives you the right to buy or sell a specific number of shares of a particular stock at a fixed price over a certain period. Now, an option contract is identified by a few key elements: the name of the underlying security, the expiration month of the contract, the exercise or strike price, and the type of option. So for instance, let's say an investor purchased one call option on XYZ stock with a May expiration, an exercise price of $30, and a premium of $3. Now let's break down the individual components of that option contract example and see what each part represents. Starting with the underlying security, in this case XYZ. Typically, each equity option represents the right to buy or sell 100 shares, which is one round lot of the underlying stock. Moving on to the expiration month, here, it's May. All listed options, those that trade on an exchange, have fixed expiration dates. If an option hasn't been exercised or liquidated before its expiration, it simply expires, meaning it ceases to exist. In our example, the buyer of the call has the right to purchase 100 shares of XYZ stock from the writer until the option expires in May. Exercise, also known as strike price, 30. The exercise price is the price at which the call owner may buy stock from the writer. For put options, it's the price at which the put owner may sell stock to the writer. Type of option: call. Remember, a call option gives the owner of the contract the right to buy the stock, while the seller accepts the obligation to sell the stock if exercised against. In our example, the call buyer has the guaranteed ability to purchase 100 shares of XYZ at a price of $30, regardless of how high the price of XYZ increases between the time the option is purchased and its expiration in May. Premium, 3. The current market price of this option contract is 3 points or $3 per share. Since the contract is for 100 shares, the purchase price is $300, $3 times 100 shares. This is the amount that a buyer pays to the seller for the rights conveyed by the contract. The market price, or premium, is not a fixed component of an option contract. Instead, it constantly changes and is determined in the secondary market between buyers and sellers. The premiums of call and put options are influenced by changes in the prices of the underlying securities. In other words, as the market values of the underlying assets rise and fall, so too do the option premiums. The premium is influenced by several factors, including the relationship between the current market price of the underlying stock and the strike price of the option contract, the time remaining until the expiration of the option, and the volatility of the underlying stock. Intrinsic value and time value. The premium of an option may comprise two components: intrinsic value and time value. Intrinsic value is the amount by which an option is in the money, while time value is the portion of an option's premium that exceeds its intrinsic value. For calculation purposes, remember that an option will only have intrinsic value if it's in the money. In, at, and out of the money. The relationship between the strike price of an option and the current market price of the underlying security determines whether an option is in, at, or out of the money. For call options, the relationships may be summarized as follows. Calls are in the money if the stock's market price is above the strike price of the option. Calls are at the money if the stock's market price is the same as the strike price of the option. Calls are out of the money if the stock's market price is below the strike price of the option. For put options, the relationships are the opposite. Puts are in the money if the stock's market price is below the strike price of the option. Puts are at the money if the stock's market price is the same as the strike price of the option. And puts are out of the money if the stock's market price is above the strike price of the option. Keep in mind that the intrinsic value of an option will either be a positive amount or zero. There will be no negative intrinsic value. If an option is in the money, it has positive intrinsic value. However, if an option is at the money or out of the money, it has zero intrinsic value. An important note is that intrinsic value is a concept that applies to an option contract. It's not based on whether the investor is a buyer or seller of the contract. Option buyers prefer that their options gain intrinsic value since they own the assets and want them to increase in value. On the other hand, writers dislike intrinsic value since this in-the-money amount represents a potential obligation if the contract is exercised or assigned to the writer. Determining time value. Determining time value. Since only in-the-money options have intrinsic value, any premium associated with at or out-of-the-money options will consist solely of time value. For in-the-money options, the time value may be determined by simply subtracting the intrinsic value from the premium. Using the earlier example, let's assume the XYZ May 30 call has a premium of 3 at a time when XYZ stock is trading at $32 per share. The premium of 3 consists of 2 points of intrinsic value, from 30 to 32, with the remainder being 1 point of time value. If the XYZ May 30 call has a premium of 3, but the stock is trading at $30 per share, how is the premium determined? With the stock at 30, a 30 call option is at the money. This means that the option has zero intrinsic value, and therefore the entire 3-point premium is time value. Generally, the longer the time until an option expires, the greater its time value. If it's currently January, an XYZ August 30 call will trade at a higher premium than an XYZ May 30 call, since the August option has more life remaining than the May option. However, an option's time value will diminish with the passage of time, and at expiration, it will have no remaining time value. Break-even. The premium of an option is a vital component in calculating an investor's break-even point. The break-even point represents the price at which a stock must be trading for an investor to neither make nor lose money. To find the break-even point, remember the phrase call up and put down. For calls, it's the strike price plus, or UP, the premium. But for puts, it's the strike price minus, or down, the premium. For buyers of options, break-even represents the amount the underlying stock needs to move in their favor to recapture the premium paid. Break-even for the buyer of a call strike price plus premium. An investor buys an XYZ May 50 call at 5. The break-even point is when the stock rises to 55. Break-even for the buyer of a put strike price minus premium. An investor buys an XYZ May 45 put at 4. The break-even point is when the stock falls to 41. For sellers of options, break-even represents the amount the underlying stock can move against them because they received the premium. Break-even for the seller of a call strike price plus premium. An investor sells an XYZ May 50 call at 5. The break-even point is when the stock rises to 55. Break-even for the seller of a put strike price minus premium. An investor sells an XYZ May 45 put at 4. The break-even point is when the stock falls to 41. Speculation versus hedging. Speculation versus hedging. Investors purchase and sell options to either speculate on the potential movement of an underlying instrument or hedge an existing position. Speculation refers to generating a profit based on an anticipated price change in the value of a security on which the investor has no existing position. Buying a call in anticipation of an increase in the price or value of an underlying instrument, and buying a put in anticipation of a decrease in the price or value of an underlying instrument are examples of speculation. Conversely, writers of either calls or puts are simply speculating that their options will expire worthless. Hedging refers to purchasing options to protect against the risk of adverse movement in the value of the underlying instrument. For example, an investor who owns stock can buy a put option to hedge the risk of the stock declining in value. The put purchase locks in the sales price or the strike price if the underlying stock falls in value. Hedging will be covered in greater detail later in this chapter. Option events. Since an option is a security with a fixed life, the contract will eventually be subject to one of three possibilities: liquidation, exercise, or expiration. Liquidate, trade, or close out. Liquidating or trading an option position is essentially an alternative to exercising the option. To liquidate an option, an investor, either the buyer or seller, executes an opposite transaction on the same option contract. Since there is an active and liquid secondary market for listed option contracts, an investor who is long an XYZ May 30 call may close out the position by selling it. On the other hand, an investor who is short an XYZ May 30 call may close out that position by buying it. The buyer of an option creates the position with an opening purchase and could subsequently liquidate the position through a closing sale. The seller of an option creates the position with an opening sale and could subsequently liquidate the position through a closing purchase. The difference between what an investor pays and what they receive is the profit or loss. For example, an investor bought or made an opening purchase an XYZ May 30 call at 3. Later, XYZ stock increased to $40 and the investor liquidated the position or made a closing sale for its adjusted premium of 11, which includes 10 points of intrinsic value and 1 point of remaining time value. Since the investor originally paid $300 but later sold the call for $1,100, their resulting gain is $800. Exercise. Exercise. The second event that would close an option position is an exercise. The investor who is long an option has the exclusive right to exercise that option. The two styles of exercise are American-style exercise. Options using American style may be exercised at any time up to the day on which they expire. All listed equity options use American-style exercise. European-style exercise. Options using European style may only be exercised at a specified point in time, usually on the day of expiration. European-style exercise is prevalent with index and currency options. Conclusion. This concludes the examination of options. Remember, the four basic option strategies are directional bets in which an investor is either bullish or bearish on an underlying stock. The buyer risks their money, or premium, in return for significant potential profits. On the other hand, the writers receive their money, or premium, upfront, and will retain these funds if the option expires worthless. In the end, remember that hedgers buy options as insurance for their core stock positions. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but it means significant support for us, and it is entirely free. Please turn on your notifications to be among the first to be introduced to the next segment. Thanks.